What is the simplest way to invest in the stock market, to find great companies to invest? Today I am going to reveal a 6-step super easy formula for you to find great companies to invest. It's super easy. Now, before I go ahead, let me tell you, if you have not yet subscribed to my channel, please subscribe, comment, and let me know what other content you want me to create for you. Alright?
Hi, I'm Harshit Mohan. I am a stock market investor and trader by passion. I am father of a lovely daughter, husband of a loving wife, and I'm also the founder of Peaceful Wealth Community.
So without wasting any time, let me quickly jump into the content and I'll show you what is that simplest 6-step process to find great companies. So the number one, net income. The company should be profitable. Net income basically means the profit. So we need to look out if the company is making profit or not. So we have to look out for net income. Is it positive or not? If it is positive, that means the company is profitable and we want to invest only in those companies which are profitable. A company who has a track record of creating profits in the past has a higher probability of creating profits in the future as well, compared to a company who has never made a profit or whose profits are very erratic, right? And we want to go with the higher probability companies who have a higher probability of making profits. Second, debt to equity ratio should be less than 1. What is debt to equity ratio? So it is a very useful feature, it's a very useful number which tells us how much the company has loan on its books, how much loan that company has taken from financial institutions. So as in our personal life also, if a person has taken a lot of loans, that means he is under a lot of financial liability and this person is obliged to pay interest payments for that loan to the lenders time to time. If the person is not paying interest time to time, then the lenders can seize the assets or maybe can lodge a criminal complaint or a civil complaint against that person. So we want to avoid this kind of situation. Same way in a company, if a company has taken very less loans, then it shows that the company will be able to sail through, to manage through the tough times. Like in the case of pandemic, a lot of companies, they got closed because they were not able to sustain the interest payments and their business was down, right? So they could not survive this pandemic. However, those companies who had very less loans, they had less interest to pay, they could survive it better than the others. So we want to go with companies who can survive tough times. And debt to equity ratio is one of those matrices which tells us if this company will be able to do that or not. So this debt to equity ratio should be less than 1. Towards the end of this video, I will show you where you can find these details in just 1 second. Okay? Next, you need to look out for the technology risk. So is the business of company going to be affected by change in the technology? How much is the business of company dependent on the technology? You have to assess that. For example, Kodak used to be market leader in the cameras, film cameras, few years back. But then it could not compete with the digital cameras which were coming in the market. Lot of internet companies, they are dependent on an internet technology which is prone to changes. So if the product of the company is too much dependent on a technology which can be changed anytime, then the business viability of this company is in question. It may not sustain for a long time. So we want to assess this risk before we invest into it. Better stay away from companies who have a lot of dependence on technology. Second, we are going to assess environment risk. So what is environment risk? Environment risk basically means, is this company liable to is liable for any environmental changes. Like if there is a change in the environment laws, is it going to cause any impact on the company's operations? Like the mining companies, the petroleum companies, plastic companies, tobacco companies. So these companies, there are different kinds of companies who operate in certain sector where environment laws can impact their business quite a lot. So you need to assess how far the company's businesses are dependent on environment. If you think there is too much environment dependency which can be changed at any point of time, or it is harming the environment to an extent where you think that okay, this business may not look sustainable in the future, then try to stay away. Next, authority risk. So governments can also ban certain companies in the interest of larger public. For example, tobacco companies, gambling companies, because the products that these make, like the business model that they have, is not in the interest of the larger public. So they are pretty regulated. They are pretty much regulated to a large extent by the governments. And when there is so much regulation by the government, there is always a risk of fluctuation in the business operations. So you need to assess how far the company's operations are going to be impacted by a change in the authority or any ruling from the authority, the governments. Right? And last but not the least, you need to see what is the promoter reputation. Among all this, I believe is the most important criteria. Why? Because if the promoter means the founder of the company, if the promoter reputation is tainted, if there is a history of scam or some kind of fraud associated with that promoter, then the chances are high that this particular company, which is also backed by the same promoter, will also have some kind of a scam or some kind of irregularity in the future. Right? So we don't want to go with people who are tainted. We want to go with people who are clean, who have a good track record. So just try to find out the history of the promoter behind the company in which you are interested to invest. If you see there is a tainted history behind it, simply ignore this company. And if you see it's a clean company, then yes, you can think on this company. You can think to invest on this company. Now, these 6 steps are not enough in itself to invest. This is just a basic filter, just one filter to help you filter out junk from a good. There are various other filters that we need to apply before we can say, okay, this company looks good. But yet, this will be your first line of defense against crap companies. This will protect you from a lot of junk companies in the market, and it will give you a right direction. Now, as I told you, I am going to reveal a tool where you can find these values in just 1 second. Let me show you what is that tool. Yeah, so this is morningstar.com, and you come here and let us say we want to find out the value of Infi. So I just typed Infi here. I'll go view all results for Infi because Infi is also listed in the US stock market, and we are interested in finding out the details of the company which is listed in NSE, National Stock Exchange India. So I will come and look out for XNSE, which is basically for the Indian market. This Morningstar has a database of all the companies listed across all exchanges in the world. So it's the biggest database of the companies. And when I come to Morningstar, I go to key ratios, and under key ratios I'll go to full key ratios data, and here in just 1 second I got to know the net income of the company. So net income is positive, that means it's a good sign, the company is profitable, right? And when it comes to looking at the debt to equity ratio, you need to come to financial health, and here there is a section called debt to equity. So you see the debt to equity of Infosys is 0.06, which means it's almost debt free. There is no debt. right? So these two parameters have been met. Now the other parameters like technology risk and other promoter reputation and all, you will have to find out by doing Google search, okay, because those are qualitative parameters, and these two parameters which are quantitative can be easily found out. Now I am going to show you one more tool called screener.in. now in this you can create different screens based on your requirement. So for example, if I give debt to equity less than 1 and net profit last year more than 0 and I run this query, it gives me a list of 2263 companies, 2263 companies who meet this criteria, right? So in just 1 second, I have a list in front of me of those companies where debt to equity, where debt is less than, where debt is manageable, and those companies are also profitable. All right. So with this, I conclude this video. I hope this video was of use to you. The link for these the link for this screener has been given below the video in the description box. Simply click that link and you will be able to use this screener link which I have created for filtering out these two parameters, debt to equity and net income. All right. So take care, have a good day, and see you in the next video.